Something just happened that hasn't happened in 28 years. The US government is spending its money to save another country's currency, not its own, but Japan's. We know this because of a leaked photo of a note from the US Treasury Secretary, explicitly stating, to do by Japanese yen 5 to 10 billion. This isn't just a casual trade, it's a deliberate rare move, and it tells us something critical about what's really going on behind the headlines. Welcome to the Alpha Brief. I'm Marcus Reid, and if you're new here, we follow the money so you don't have to. Today we're going to pull back the curtain on this currency intervention, expose the real reasons behind it, and show you exactly what it means for your wallet. Now, you might be thinking, Marcus, what does the Japanese yen have to do with my life? Everything. If you own a home, the interest rate on your mortgage is directly tied to the global bond market, which this intervention is trying to stabilize. If you're carrying any debt, like on a credit card or a car loan, expect those rates to keep climbing as the government's own borrowing costs skyrocket. If your paycheck hasn't moved much, but your grocery bill keeps getting bigger, this is a direct consequence of the policies that make your money worth less. And if you're trying to save for retirement or just build up a little cushion, the value of those savings is being slowly, subtly eroded. This isn't just about currencies, it's about the price you pay for everything, and it's about the stability of the entire financial machine. So, we need to set the stage here. The US government is now buying Japanese yen. This isn't just some casual trade, this is a coordinated action. We know this because it's been confirmed as the first joint intervention in 15 years, intended to lift the Japanese currency from a near 4-decade low. President Trump, for his part, earlier said the joint intervention was a signal of Washington's friendship with Tokyo. He actually stated,
President Trump said, and I quote, "We have a good relationship with Japan. We're very strong, very, very strong financially. And they are, they have a weakening yen and they wanted a little bit of help, and we're always there for Japan. Japan's been very good to us, with the exception, of course, of Pearl Harbor."
Now, this intervention, this buying of yen, it's rare, really rare. And the context around it is even more concerning. The same week that Scott Bessem's note was photographed, the U.S. national debt crossed $40 trillion for the first time in history. Think about that. In March of 2024, the debt was only $34.5 trillion. Today, it's $40 trillion. That's $5.5 trillion in just 2 years. And this isn't happening because of a recession, or a pandemic, or a stimulus package, or a world war. Nothing technically happened to cause this spike, right? This is just what the machine does now. It's getting faster and faster. When a country's debt starts growing that fast and gets that big, you run headfirst into what economists call a trillemma. The United States is desperately trying to do 3 things right now, simultaneously. Number 1, reshore, bring those factories home, make our own chips, our own weapons. Because if your adversary nation is making them for you, well, you're in trouble. You can't fight your own wars in the Middle East if you can't make your own supplies. Not good. Number 2, price stability. The US needs to keep inflation down. Politically speaking, people will forgive and maybe forget almost anything except the price of groceries and gas going up, up, up. And the third thing the US needs to do is keep the economy stable. That means a strong stock market, low unemployment, keeping the whole machine growing, so that the money the US government gets from our taxes keeps flowing in to pay the interest on that staggering $40 trillion debt. Here's the problem with the trillemma, though. You can only fight 2 of those 3 things at once. You can't fight all 3. Why? Well, if you want to reshore and make stuff in America again, then American factories have to be able to compete with Chinese factories, and they can't do that with a strong dollar. A strong dollar makes everything we build here more expensive for the rest of the world, and everything they build overseas cheap for us. So reshoring needs a weaker dollar. But a weaker dollar means everything we import costs more for us. So there goes controlling prices, right? Inflation goes up. All right, but let's say we keep the dollar strong and we fight inflation instead. What happens then? We kind of saw a preview. For the last 6 weeks, Fed Chair Kevin Warsh talked about price stability first, which implies a strong dollar. So what happened? Everything went down. Stocks went down. Gold, Bitcoin, they all went down. This whole AI trade, which is the story that's supposedly keeping the stock market strong right now, it breaks. And the worst part that's happening is that bond interest rates on what's called the long-end treasuries, they're going up, up, up. The 30-year treasury went up to 5.27%, which is the highest level since June of 2007. That's not good. So that is the trillemma, right? So then, the question is, how's the US going to fix it? Which of the three will the US have to sacrifice? If you look at the first one, the US wants to reshore. That's a national security threat. That is not a negotiable thing. Without that, we can't spread democracy to the world, can we? Number two, the US has to keep the jobs and the bond market stable. Because at $40 trillion worth of debt, that's not negotiable either. Which means the thing that has to get sacrificed is number three, prices. You, the listener, are going to pay more. How do we know that this is happening? We know because the bond market, check this out. When the bond market looks at this trillemma and sees no good way out, it does the only thing it can do. It demands to be paid more interest. That's part of why the 30-year bond yield keeps going up. Investors are basically saying, look, I'll still lend you the money. I know you'll probably pay me back. You're going to print the currency, which means you're going to pay me back with weaker dollars. So pay me more right now. Rates are going up because it's the market's way of demanding to be paid more for the money printing it thinks is inevitably coming. And that makes the problem even worse, because every point higher on this yield makes the $40 trillion worth of debt more expensive to carry, which means even more borrowing, which means more bonds to sell, which pushes yields even higher. It's like using a credit card to pay down a credit card to pay down a credit card. You get the idea. So based on this evidence, it looks like the bond market believes that in order to solve this trillemma, what needs to get sacrificed is the dollar. Except it needs to be done in a way that's not obvious to the market. Why? Well, it's because if the US comes out and says, hey, we're officially devaluing the dollar, then everyone holding trillions of dollars of treasuries would start to sell them. The dollar's value would crash, and rates would go up to counterbalance it, which would be very, very bad. So a weakening of the dollar is the goal, but it has to be done subtly. It has to be deniable. Why, when the US actually bought the yen, it also didn't sell dollars to do it. It sold euros, which is the only foreign money the US has. And as a result of that, the yen went up, right? The dollar went down, but on paper the US never sold a single dollar. Now, because the dollar is always measured relative to something else, that something else they're choosing is the yen. And that's because out of the three things from this trillemma, sacrificing the dollar is the only option that doesn't cause an immediate crisis for the US economy. Unfortunately, it does cause a slow one. It's just going to be less noticeable. And here's how it's going to work. What needs to happen to sacrifice the dollar is a cooperation with Japan. And that's because Japan is America's banker, right? It's the biggest foreign holder of US government debt with over $1 trillion worth of treasuries, more than any other country. And that's because for 40 years, Japan sold us cars and chips and machines and Pokemon cards, and instead of putting their dollars into their savings accounts, they lent them right back to us by buying US government bonds and collecting the interest on them. That's how the US borrows a huge amount of money. It issues bonds, Japan buys them, and that in return funds US deficits. And that worked because Japan had no better option. Their interest rates were zero, and ours were not. So their money lived here. Then everything started to change. The yen started to collapse. All you have to remember is that when the yen goes up, when it strengthens really fast, something called the yen carry trade unwinds, which means everybody sells their US assets to pay back their yen. And what happens is we get markets all around the world to correct and possibly crash. We saw a small preview of that in August 2024 when stock markets all around the world went down really fast. Now, this problem has actually existed for a really long time. It's not new, but the longer the yen keeps weakening, the closer Japan gets to the point where it might be forced to make the line on this chart go up to strengthen the yen, which is done by either raising interest rates, which is what they're slowly trying to do, or by selling its US treasuries to raise its dollars to buy back its own currency, which they're also doing. And both of these roads lead to the same outcome, right? America's biggest creditor is selling US debt right when the US needs to borrow more money to finance its insane spending. Getting even worse, thanks to the conflict that's happening in the Middle East. And that's why the United States is stepping in to buy the yen. It is not rescuing Japan out of generosity. The United States is rescuing Japan because if Japan goes down, It takes the US bond market with it, along with all the other markets around the world as well. A weaker dollar, though, helps America reshore. A stronger yen keeps Japan's pension money from panic selling our treasury bonds. Right? So what the US needs and what Japan needs are the same things. They need the dollar to go down and they need the yen to go up. And that's why Scott Bessent is buying the yen. Now let's connect this back to you directly in a way that impacts your everyday life. For your savings, you're seeing interest rates go up on your savings accounts, maybe even CDs. But the purchasing power of that money is being silently eaten away. The weakening dollar means your dollars buy less tomorrow than they do today, even if the number in your account is a bit bigger. It's like filling a bucket with a hole in it. At the grocery store, a weaker dollar means everything imported costs more. That includes a lot of your food, your electronics, your clothes. We're talking persistent, grinding inflation. Not the kind that spikes and then goes away, but the kind that just keeps prices at elevated levels, making your budget tighter and tighter. You're paying $120, $130, $140, $150 for what used to be $100. If you own a home, the government's need to borrow more money combined with the bond market's demand for higher interest means mortgage rates are not going back to the lows we saw a few years ago. They're staying elevated, making home ownership more expensive and locking some people out of the market entirely. That 5.27% on the 30-year Treasury, the highest since 2007, that directly impacts what you pay for a roof over your head. For your job security, the reshoring effort, while framed as national security, comes at a cost. If American goods are still too expensive, even with a slightly weaker dollar, it can create an uneasy balance. Companies face pressure to cut costs, and often that translates to job cuts or stagnant wages for workers. The economy needs to stay stable to keep the tax money flowing, but a slowly devaluing dollar makes that stability a tightrope walk. For your 401k, the stock market is being propped up by narratives like the AI trade, but the underlying mechanisms are fragile. If the yen carry trade unwinds completely, or if Japan is forced to aggressively sell US treasuries despite these interventions, it could trigger a correction or even a crash in markets all around the world, as we saw a preview of in August 2024. Your retirement savings are exposed to this global game of chicken. For your credit card, as the cost of government borrowing goes up, so does the cost of consumer borrowing. Your credit card rates, personal loan rates, auto loan rates, they all follow the market. So carrying debt becomes more expensive, eating into your disposable income and making it harder to get ahead. The bottom line is the US government is facing a debt crisis, and its solution is to sacrifice the value of the dollar in a deniable, subtle way. This strategy impacts every single one of us by making our money worth less, our borrowing more expensive, and our financial future more uncertain. They're trying to manage a slow burn rather than an immediate explosion, but the fire is still there. So, what's my read on where this is going? I expect to see continued, subtle devaluation of the dollar, carefully managed to avoid outright panic, but persistent enough to keep inflation simmering. The US will continue to lean on interventions and cooperation with countries like Japan to maintain an illusion of control, all while the national debt continues its relentless climb. This isn't a quick fix. It's a long-term strategy to manage an unsustainable situation, and it means the purchasing power of your money will likely continue to erode. The number I'm watching next, the one that tells the real story, is the 30-year Treasury yield. If that number keeps pushing higher, it tells us the market's skepticism about the government's ability to manage its debt is only growing, and that means more pain for your wallet. We'll be tracking it closely right here on the Alpha Brief.